Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing JinkoSolar stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.4 billion market cap. They're trading at $27 a share and they have 51 million shares outstanding. JinkoSolar engages in the design, development, production, and marketing of photovoltaic products. They offer solar modules, silicon wafers, solar cells, recovered silicon materials, and silicon ingots. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. They have negative free cash flow every single year, even though they generate lots of revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses. That is positive each year, so it looks like they're investing back into CapEx, which is why they have negative free cash flow. Revenue is the sales for the company, and it grew a lot. It doubled from 2020 to 2021. These numbers are in US dollars, and then it grew again to 17 billion in 2022, still 17 billion in 2023. Their revenue per share is $3.25, and their share price is 27, which is a really attractive price multiple. I think that's a 0.1. And they pay a dividend. They're the only company in this industry that does pay a dividend. It cost them $77 million to pay that dividend, and they have negative free cash flow. So it looks like they're using debt to finance the dividend. We estimated 4 years of future free cash flows. We also estimated the terminal value, which all cash flows past year for, that's $3.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.4 billion. We divide that by 51 million shares. And we get a calculated stock price of $46. They're trading at $27, so they're trading at a 43% discount. It's a buy according to the model. There are 26 companies in the same industry as Jinko, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the second most in CapEx, $2.1 billion. That's why they have negative free cash flow. They have a really high debt-to-equity ratio. For every dollar of equity, nearly $3 of debt. They're the only company that pays a dividend. They still have negative free cash flow, but it is better than the average. They rank 7th in market cap. They have amazing price multiples. They're trading at 1.6 times earnings, which is the best on this list, 0.1 times revenue. They generate more revenue than any other company on this list. It's not even close. And they're still growing a lot. They have 5-year annual revenue growth rate of 36%. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $11,000 today. That's a 15% return, a 1.4% total return. Let's take a look at their first quarter presentation slides. Revenue in Q1 2023, $3.4 billion. Now it's $3.2 billion. So it's down a little bit. It was much higher in the second, third, and fourth quarter of 2023, over $4 billion. It is helpful the numbers are in US dollars. Total shipments in terms of megawatts, that's a dark green line. It peaked at the end of 2023. It's down a little in the first quarter of 2024, but a lot higher than the first quarter of 2023. Same thing with module shipments, has a similar trend. Gross profit margin, it was highest in the third quarter of 2023, 19%, 840 million of gross profit. In the first quarter of 2024, gross profit is down a lot. It's 379 million, down from 588 million. Same thing with the margins are down a lot, 12% compared to 17%. Net income for the first quarter is 65 million with only a 2% margin. It was much higher last year, 122 million, 3.6% margin. This is their adjusted net income. For GAAP net income, it's a little higher, 84 million. They have 2.4 billion of cash, 1 billion more than last year. Accounts receivable is 3.4 billion, 2.8 billion of inventory, which is less than last year, more than last quarter. Property, plant, and equipment is their biggest asset, 6 billion. Total assets, 19 billion. Total debt, 3.7 billion. 1.3 is due within 12 months. So they're going to need to refinance their debt at a higher rate, likely. Total liabilities, 14 billion. Equity, 4.8 billion. they've been really leveraging their N-type technology. N-type is more efficient than P-type. It's also more expensive though. Module shipments increased 53% year over year to 20 gigawatts, and they're number one in their industry. N-type shipments accounted for nearly 80% of all module shipments, and 50% of shipments to North America. Here's their plan for 2024. Mass production efficiency of N-type cells to reach 26.5% by the end of this year. And they expect shipments to be 100 to 110 gigawatts, about 25 in the second quarter of 2024. Their N-type products are expected to reach 90% of total shipments this year. Let's look at a stock on Simply Wall Street. Its last price 25, 1.3 billion market cap, down 15% in the past week, down 39% in the past year. Here's the stock price since they started trading. Looks like it started in 2010 at $10. It did more than triple in 2010, then came down to $2 in 2012. That was its lowest point ever. And then 8 years later, it peaked at $76. That was at the end of 2020. And the stock is down about 60% from that point, currently trading in the 20s. Look at Wall Street's value, 50 cents. They say the stock is 4,900% overvalued. You don't see that too often. They're so bearish on this stock. However, 7 analysts priced this stock at 38. Their revenue forecast for this year is 119 billion Chinese yuan, which is about 17 billion US dollars. Next year, 141 billion, which is 20 billion US dollars. You just divide by 7. And then 166 billion. And their free cash flow forecast is 1.6 billion in 2024, 3.2 billion in 2025, 15 billion in 2026. If they hit these targets, the stock could 10x. Their revenue in 2013 was only 5.5 billion, and now it's over 100 billion, close to 120 billion Chinese yuan. The red line is their debt, the blue line is their equity. Their debt is always higher than their equity, and it seems to be separating more and more. Debt of 52 billion, equity of 34 billion. And this green line is their cash. They have 17 billion of cash. Their dividend is 5% according to Simply Wall Street, and they are forecasting no dividend by the end of 2024, a 0.4% by 2025, and then back to zero in 2026. It's kind of an odd way to forecast their dividend. 35% of the company is owned by insiders, 34% by the general public, and 31% by institutions. The founder is the biggest shareholder. He owns 18% of the company, and it looks like a lot of individuals own the stock. Mackenzie is a Canadian company. They have a stake in Canadian Solar, and then there's a lot of names I'm not too familiar with. Some bigger names like Bank of America. Look how much the employee count went up. It was only 8,800 in 2013. Now it's 57,000. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Wiener Börse, and Bulgaria. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.